Are we? We are live. Excellent. Okay. Good evening, everyone. Thanks for coming out. Our Thursdays here are EthVan Talks at Decentral. Thanks. We got a few new faces here, some familiar ones, some old ones we haven't seen in a while. So thanks everyone for coming around. And yeah, so I guess a few announcements. We're getting back to running. Yeah. We're back running. So Saturday at noon, if you're looking to do some light yogging, potentially in the rain, potentially sunshine, who knows? We've got sunny so looks sunny. Okay, promising. If you're looking to do some yogging, staying fit over the after, just work off some of those holiday carbs that you probably indulged in. Come meet up at the Nouns Running Club at Cole Harbour, at the Cactus Club at Cole Harbour. So just meet up there. There's a Nouns group as well. So if you're looking into the Telegram, yeah, I guess we can just hit up Owen, or if you're not already in there, or we can we'll post some links on the Discord as well. Sure. Let's do that so we can bring all that in. And then next Wednesday we're going to be having ZK study group. So we're back at it again for more math and research. And yeah, so 6:30, bringing it here. So if you're interested in that, and I think NFT and Coffees is that same week as well at 4 to 6. So just stay posted on that on our Discord. If you haven't joined the Discord, there's two different ones up there. There's one for Decontrol and the other one for EthVan. So feel free to join both of those so you can stay up to date and informed. Then on the 17th, which is another 2 weeks from now, where are we at here? Yeah, about 2 weeks from now. Actually, the Solana crew is planning to have a monthly meetup here, so they're going to do that as well. So anybody that's getting Solana curious, you know, maybe you can come for that. But all right. Yeah, we've also got a bunch of the resources in the back. Like, I don't know if anybody's ever used the Pepsi machine, or the we're getting the BitCoil working so that you can actually dispense food and little items and things out of a vending machine. Yeah, last night actually we had some of the Bitcoiners were here for Bitcoin birthday. They hacking away on the Lightning stuff, and they ended up getting Lightning working on the Pepsi. So you can actually use Lightning payments to dispense yourself beverages, along with well, the Polygon portion is currently broken. Not sure what's going on there, but it was working recently. So we might need some help with that if anybody's looking to kind of debug some issues there, but looking to get other networks on that. So there's a bunch of different varieties and ideas here of things that we can do around this place. So if anybody's looking to get those developer tools all sharpened up and hacking away, yeah, let us know. We'll get you on it. So wicked. Alrighty. Well, we'll take let Misha take it away from here. Yeah. Yeah. Cool. Thank you, sir.
So hi everyone. And today we're going to talk about the passive income in DeFi. I was attending this meetup for quite a long time now, like for half a year maybe a year. And I felt that there's a lot of technical things that people talk about here. And I wanted just to balance this out with something like not that technical. So today we're going to talk like pretty basic, especially for those who like been in the industry for a while. And the intent here is for those who like still have struggles with understanding the basics and how to go from like zero to the full understanding of DeFi. There is a way to go. So the idea is that really, if you feel that you don't understand something in this talk, like feel free to interrupt me. And yeah, that's how it should be. So let me just start with a question. How many people here know what DeFi is? Just to be clear, like everyone is good here, yeah, right? All right, so let's go from there. So I'll start really far away. So in traditional finance, there are different ways to earn income on your savings. You can go to the bank and open the savings account there. You can basically go to the broker and buy some shares through the broker. You can buy some real estate, or you can do a lot of different things with your funds. There will be different risks. There will be different returns. They will be all like pretty low compared to DeFi. And yeah. So what we normally consider when we do invest, we normally consider like two factors. It's like potential return and potential risk of your investment. So if you're a risky person, you like seeking for something higher. If you like probably wanted to retire, you just want to not lose all your funds that you've accumulated through your life. So that's that's the basics, and normally there's a risk return ratio. A lot of investors like look at that, and in TradFi this is pretty low. In DeFi this is normally way higher because the return is way higher as well. So in the DeFi there are various ways how you can earn money. Like I've put trading here. It's not quite DeFi, but it's overall like trading on crypto and using maybe decentralized exchanges. So there's like pretty risky way. If you know what you're doing, you can earn a lot of funds, but it's like definitely not a passive income here. There's lending, so you can lend your cryptocurrency to someone else to use it through different platforms like EthVan, and then other people will be paying interest for that money. It's like really similar to the traditional finance. When you go to the bank, you open the savings account there, and the bank lends this money to other people, and then these people pay a bit higher interest rates, and the bank shares the interest with you here. So with a DeFi, though, the lending normally pays you more because there is no like middleman there. So for the bank, they like take pretty big chunk of all that income to maintain their branches, etc. And in DeFi, normally the platform fees are minimum, and they are also distributed to token holders. So there is also a staking opportunity. So it's for blockchains that are they use proof of stake. So basically, you provide your funds to support the system. The risk here, I would say, is pretty low. Like even comparing to like TradFi, it's still super low. It's only basically the smart contract risk that is normally well audited if you're using a well-known blockchain. However, the return here is pretty low as well. So it's also like currently, I guess, on the Ethereum, staking is about 4%. On other chains, this may be a bit higher, but normally you won't get more than 10% in like well-known blockchains at least. And then there is a farming or liquidity provision. It's basically the same. So you basically provide your funds to the centralized exchanges so that they can maintain their behavior. So as in traditional exchanges, they need to have some funds to allow other people to trade. Here in decentralized exchange, you provide this liquidity or your funds to the platform, normally in the 50-50% ratio. So you provide 2 tokens here. One token is of, let's say, X amount of dollars. Another token is also X amount of dollars. And these funds will be later used by the decentralized exchange users to do the exchanges from token A to token B. And they will share small fee for that. And that's how you'll be earning here. So that's basically overview of like what's there. It's not the finite list, but that's like the most popular options. So how DeFi is different from the traditional finance? So obviously in DeFi, as it's built on the blockchain, there is fees. So you have to pay gas fees for every single transaction. That's a bit different from the traditional finance. So if you like open a savings account, you can go as low as like $100, and then you can still earn some profit there. If you will go with $100 to Ethereum currently, probably you won't earn anything because you'll just spend about $10 on entering to the like whatever you will be entering, and then $10 to exit from there. So your loss will be just like $20 from just like going up, like in and out. So that's not good news. However, good news is that you can go with far bigger amount, and basically independent of the amount, the fee will be more or less the same. So that's like a thing to consider that is super different from TradFi. Also in DeFi, there is usually no or little brokerage fees. By that I mean that when you go to the decentralized finance application, normally there are some fees that you pay to use that platform, but these fees are distributed to the token holders. So, and you can also be technically a token holder. So like for you, it feels like there is much less fees there than traditional finance, at least when you operate with some amount of money that is, again, cover your gas fees, so you're not paying too much in percentage terms. And then in DeFi, there's also transparent mechanics, so but also hard to understand. So as probably most of you know, there's like everything is written in the smart contract that is basically the programs that run on blockchain, and there everything is transparent, so everyone can see the smart contract code and audit it. There's user interfaces that interface those smart contracts, so you can see every single transaction happening there. You can see all the amounts happening there. So there is no kind of risk for you for not knowing what's happening in the platform that you're using. However, you have to understand how to analyze the data. So it's a lot of overwhelming things here, I think, for people who are just trying to use decentralized finance coming from traditional finance, because in TradFi you don't have that much data, and here you have like all the data available for you, but you don't just know what to do with the data. So in DeFi, obviously, there are a lot of risks. So first risk, I would say, is like the asset volatility or crypto market volatility, because in a lot of DeFi tools where you will be using your crypto to earn some revenue, you'll be providing some liquid assets like Ethereum or maybe Avalanche or whatever you'll be using. And these assets can go like up and down, maybe 20% per day, sometimes more. That is like a huge volatility for like traditional market. Like US dollar can never go like hopefully in one day like plus or minus 20%, but it's like super okay for crypto. So that's definitely for you to consider. And there's also impermanent loss in decentralized finance. So in decentralized finance, normally people refer to impermanent loss as when you don't gain that much as you could if you like just hold the asset. So for example, you enter the decentralized exchange with, again, let's say $100 of volatile asset like let's say Ethereum, and the 50% is over $100 with USDC, that is stable coin, so it's just $100 US dollars that are digital. And then you're entering this position, and let's say your Ethereum now doubles in price in 1 month. So you could be just holding that Ethereum and earn like twice as much. So let's say initially had just like $200 in Ethereum. Now you would have had $400, but instead you were in the pool, so you were earning some interest on that decentralized exchange. But basically, the thing how it works is that it always maintains the 50-50 ratio. So now you end up with everything converted to the USDC. So you now only have the stable coins. You have the 100 plus 100, 200 in the stable coin, plus some interest that you've accumulated during this month. So let's say it's $50. So you have $250. In contrast, you could have had like $400. So that's your loss here. But that's like you still gained, but just didn't gain that much. In finance, impermanent loss and in a different also applications can be referred to also just like losing funds when you buy low and then the currency or the stock price goes even lower and you sell there. So there's impermanent loss there. Here it's a bit different. Again, it's just like unrealized gains. Also in DeFi, the smart contract hack or poor system design is a huge problem. And I'm a developer, I see this all the time. So a lot of platforms out there, they just hire developers to write some code that works well. It looks like it works well, but when people bring their, like, let's say $10 million or like $500 million, then some smart people find that there's a tiny little kind of bug in the code, and then they figure out how to drain part of these funds or even like potentially all of the funds that are there. So there's a lot of protection against that. People do the smart contract auditing. They do the they basically have bug bounty, so they pay whoever tries to hack their code and whoever finds the vulnerability and report this vulnerability to the team. Then they pay some amount of the bug bounty just to that person, so that they don't utilize this as a hacker, but rather act as a white hacker, so just report this to the team. But still, I think this is like a major risk to be aware of. Then I would say this is not a major risk right now, but there is also a parent blockchain risk. So basically your smart contracts will be running one of the blockchain. If it's like Ethereum, Avalanche, or other main blockchains, I guess like you can be safe. But if it's some like not well-known blockchain that has small number of nodes, so there is not much basically cash in this system, then if someone's tried to attack the system, maybe they will try to do the 51% attack, so to just like steal the funds of the system, or maybe the system will just like get blocked or shut down, whatever it is. Then there's a risk that all your funds, independent of the smart contract, independent of the business logic, just like the base layer, like the internet is shut down, so you cannot use it anymore. And then the last risk that I've put here is centralization. So basically a lot of products out there, they have a limited amount of users who can control the system. So again, in decentralized finance, it's decentralized. So normally people want to have it like completely decentralized so that there is no single kind of person or group of people who can like shut down the system or who can maybe withdraw the funds from there. But sometimes, especially in like young projects, this happens that initially it's not a DAO, it's not a decentralized autonomous organization, so that there's a small group of people who can control the project. And also this sometimes happens that the token allocation is that the team or initial kind of advisors, investors, they get like 80% of the whole token supply. So then if these like one team member decides to sell their tokens, they can sell like up to, let's say, 20-30% of the tokens that are available. That will just basically dump the price of the token. So there's like a huge risk here as well. Though I think the proper like due diligence here will help you to understand like whether or not this is the case. So for the like low risk DeFi opportunities, are there any? Because we all know that there is a lot of kind of volatile assets, there's a lot of risk there, but are there any opportunities that you can earn like pretty high interest rates for the traditional finance, of course, having pretty low risk? So there's, in my opinion, two ways there. So one way is staking, as I mentioned before, so you can just provide your funds to support the network. That is kind of safe way to earn some income. And this opportunity is great for some opportunities, for some people. I'll talk about this probably a bit later. And the second opportunity here is the yield farming. So basically you can provide your assets to the decentralized exchange so that they can, like the users of this exchange can use these funds to do the swaps so that you can earn from the fees from the platform. So both ways, I think they're pretty low risk, and they also provide you with some kind of good for the traditional finance interest rates, and also they are, I would say, they fail good. So you're not finding anything that feels that you're like robbing other people or whatever, just like mimicking the traditional system, and people are paying for using these tools. So for staking, basically you lock funds for some period of time to earn profit. So there's low risk, but also low return. So here in this screenshot, I've taken this, I think a few days ago, like this Tuesday, is a current return of the Ethereum and Polygon staking in the Lido Finance. So there's a kind of aggregator for different, that allows you to use different staking platforms. There's a caveat there that normally in staking, there is a minimum amount that you can use to do staking. So without like huge amount of funds, normally cannot do that. But there are different aggregators like Lido Finance who allow you to basically aggregate those funds together, and then you can use them. So on Lido Finance, currently on Ethereum it's 3.4%, and on Polygon Matic it's 4.5%. So like considering current like savings account interest rates, it's like even low, but overall, like if we think globally, when the interest rates are like close to zero normally, this is still a good return. And also the like good thing of that is that you don't lose your initial assets. So if you're betting Ethereum price to now go up, you don't want to like sell this Ethereum and try to get some like maybe 15% return on your like stable coin, because you just want exposure to Ethereum. You don't want to lose it because it can go up in one night and then you will lose all the gains. But also I think to consider here is that there should be a lockout period here. Some like basically aggregators like Lido Finance, they may allow you to not have that lock period, but overall you will have to lock these funds for some period of time. That's how you will be limited in using these funds if you need them. So for the yield farming, it's another kind of low, medium risk opportunity with medium high return. So you are providing your funds, as I've mentioned before, to the decentralized exchange so that others can basically use these funds and you will be earning some commission from those swaps. So there is definitely no lock period here. That is good. So you can just basically use the platform, and when you need those funds, those tokens that you've provided there, you can just withdraw them and you're good to go. However, it's still a bit technical here, I feel. So that you like, in contrast to like staking, where you can just have one button like that you click, you have MetaMask transaction, you do your deposit and you're done. Here you have some setup, and this setup may affect your performance. And then there is different protocols that allow you to do yield farming. Some of them, they have pretty different terms, so that you may even end up that you lose your fees if you didn't get much based on the platform rules. So, but definitely much higher opportunities here. So then there is stablecoin pools. So if you think about the pools before here on the yield farming, there is a caveat that I've mentioned initially, that if there is like one of your tokens that you've provided to the pool is going up, then you end up with a cheaper token. It's just how it works. So that the ratio is always 50-50 in the dollar value. So that means that if you're holding two or at least one volatile asset in the pair that you're providing to the decentralized exchange, then you like basically are risking that you will be ending up with a cheaper token in case the market is really volatile and all the crypto is going up. So you'll have the loss here. But if you're using stablecoin pools, you basically avoiding these loss. So your returns are more stable. And here you're basically betting whether or not you earn something. So you can either, like, worst case scenario is that you provide your funds in stable coins and no one uses this particular pair. So let's say in this screenshot to the left, like it's USDT, EUSDT. So basically both of them are US dollars. And then when you provide them to the pool, the risk like that you have is basically the smart contract risk, obviously, but apart from that is no other risk. So worst case scenario is that no one at all uses this pair, and then you end up with zero fees earned, and you only lose the money for do the transaction fees like in and out. And if you're using cheap blockchains like Avalanche, that's like maybe a couple of bucks or even less. So in my opinion, that's like pretty stable way to get some return. And then if you're using the pair of stable coins that use the same initial currency like US dollar and US dollar, then like your bet is that if both of the stable coins are properly implemented, then your ratio will be always 1-to-1, so that there is no way that you can end up with only one token that is cheaper, because they will be always like basically equal to $1 US. So now I want to talk a bit like why it's important to choose a blockchain and how you should do that. So I've mentioned a lot of times during this talk that when you like use Ethereum, for example, and you just enter some like decentralized exchange and then exit, you can lose, like, depends on the system, but and the time, but like $10, maybe $20 on that. And if you're entering with small amount, this like influences your portfolio a lot. So you have to make sure that you choose blockchain right. So how to do that? You can just go and check out like CoinMarketCap, for example, and see which blockchain has a lot of total value locked and which blockchains have been around for a while, so that you're sure that this is not the blockchain that just like emerged and there's no one who is really using it, so that there is risk again of the shutdown of the blockchain. I've mentioned high daily volume or total value locked in the blockchains, also good metric. And then the consensus mechanism, it's how the blocks are confirmed in the blockchain. Maybe also a way to look in the blockchain to do like a bit deeper research, so that you just feel comfortable about how it works overall. There's no like strict rules here, but I would say that if you're like reading about like consensus mechanism or how the blockchain works and you just like feel that it's like somehow strange, then I would just avoid the blockchain. And then the last basically bullet point here is that the transactions are cheap for DeFi, I would say this like one of the major points for you if you don't have a lot of funds and you don't want to just play around a little bit to feel how different pools works, which platforms do you want to use. You don't want to spend a lot of money just on gas fees, obviously. So if you choose maybe Ethereum, this would be like pretty high gas fees. But if you choose layer 2s that are basically cheap Ethereum implementations, or you choose different blockchains that are cheaper than Ethereum, then you can end up reducing your cost like up to 100 times, I would say. So instead of paying like $10 or $20, you would end up paying like cents, like maybe 3 cents, 5 cents, 10 cents, depends on the network and conditions. So how to pick a desired platform and pool if you want to use a decentralized exchange? So first one is to choose a blockchain based on the criteria before. So just like choosing which one you want to go with. I would recommend going with something like Avalanche, maybe Polygon, maybe layer 2s like Arbitrum, so that they are relatively cheap, and then they has been around for a while. It's not Arbitrum though, but I would bet that it's pretty big chain right now with a huge TVL. So I think it's more or less safe. Then the next step would be pick the reputable DeFi platform that works on that blockchain. So again, there's a lot of DeFi platforms out there, and when you will be picking the blockchain, you have to understand that there is different platforms that work with different blockchains. So if you pick, like maybe Ton blockchain that for some reason you feel like that it's secure, then you will realize that there's not much decentralized exchanges or another DeFi platforms that work there. So you want to make sure that your platforms work on your blockchain. Then do your own research basically, so that like you understand what the platform is doing, how it works, and that you feel comfortable with trying out. And then basically you will validate your understanding with some small transactions. So I would say like $100, $300, something you feel comfortable with, so that you don't still lose that much in percentage terms on fees. And you also understand that you're profitable. And then you can just enter, let's say, one of the decentralized exchanges, be there for months, exit, and then after you exit, you just make sure that the loss that you have, if you have any loss, is just because of the transaction fees. So let's say during that period of time, you had gain of like 3%, but you're also lost like $2 in the just gas fees, and in total you have a loss of 50 cents, dollar or something. Maybe you have different amounts, so you have different losses here, but still you want to make sure that your losses are only because of the transaction fees and not because you didn't understand something about the platform. So that's, I think, a key component here to understand. And then the last one, like basically when you understand how it works, you go with like a full amount or close to full amount and really like stay in that decentralized exchange for a while and see and keep monitoring the performance of the decentralized exchange, and check maybe their Discord, their website, the reports of the news, whether or not they've been hacked. Sometimes when the platform is hacked, you can still have some time to withdraw your funds, or at least it's always better to know that the platform was hacked if this is the case, or just to understand if your pool is like from, let's say, 20% interest rates, it's going down to like 0.5 interest rates. Probably for you is the best choice just to withdraw the funds and try with some other platform or other pool on the platform. So let's see what the popular options are there. So I would say like pretty popular option is Balancer. So they work, it's decentralized exchange that work on different blockchains. They support Avalanche blockchain, they support Ethereum blockchain, they support Arbitrum, Optimism, a lot of layer 2 blockchains. I would say they're pretty secure, they are well audited. So yeah, my personal opinion, not advised, but I think they are pretty successful there, and their interest rates or APR are pretty good as well. Another option that you can go with if you choose Avalanche especially is Traderjaw. The Traderjaw is Avalanche native blockchain decentralized exchange that works on Avalanche, Ethereum, also like pretty much like Balancer. but they are native to Avalanche, so they have some cool features there, and their performance on Avalanche blockchain is a bit higher than of the Balancer. They've been also around for like a few years now. For the decentralized finance, it's pretty like long periods. They have been audited a lot, so I would also bet they're pretty secure. And then like more recent development is like DeFi Finance. They, I would say, a bit more risky. They aggregate different tokens from different pools, and they provide even higher return, but they, again, like maybe not that well audited, yeah, so you just have to do your own research and pick like one of these or go with their own options, but make sure that there's a lot of assets there in the platform. Make sure that it works on the desired blockchain, and basically do your own research. That's the major things that you have to consider. Let's see like the Traderjaw Stablecoin Pools. What is there? So let's focus on this platform. So here in the screenshot, you can see the major stats that you will see. You will see the volume, daily volume. You will see basically the liquidity that is there. So currently here's about 400K locked in this particular pool. That is kind of good. So you don't want to go to the pool probably that has low liquidity, maybe like 10K is considered to be low. And then the APR or interest rates for the last 7 days was 16%. So again, stablecoin pools, both are baked to the US dollar. So I would say there's a pretty like stable pool, and it gets you 16% currently. Again, it changes over time, but pretty good interest rates comparing to TradFi. Even now, like 5.5%, I think is the best that you can get currently in Canada in TradFi. And then there's much more options here, so you want to definitely check out their documentation and do the research. Yep.
I see close to the APR there is a 7. Is it working? Oh, here. Oh, thank you.
Yeah. So yeah, close to the APR there is a 70. So does that mean that after a week I move out with 16%?
So this percentage is annual percentage rate.
Oh,
so
okay.
That's what is per year. But they show you only like per 7 days, because they cannot guarantee that. It depends on the like whether or not the people will be using this particular pair of tokens. They can't predict that. So basically, what you will end up is that you can check other resources that show you the APR, how it changes over the longer period of time, like a year, and you'll kind of have a sense of like maybe the return over the last, I don't know, half a year. Depends on the pool. Some pools, they have been around for like only a few months. So that's okay, but just you won't get that kind of historical data. But this one, this changes over the time.
Oh, okay, thank you.
Yeah, you're welcome. So yeah, and then the Traderjaw, they also 1 year ago or so, they introduced the Autopool feature. I think for the like beginners, it's pretty great, because if you think about the impermanent loss that I've mentioned, that if you have the pool like for example Avalanche USDC, so Avalanche is volatile assets, USDC is the stable coin, then if Avalanche going up, like just now it went from 20 to 40, if you had the assets in this pool, you're basically losing funds, and you end up having only USDC because the pool is moving, and now you have only USDC there. So to avoid that, they've created the Autopools feature. So it's just on the website, another tab there. And you can just go and choose one of these pools. So it's, I guess, on the Avalanche blockchain. Not many options, but what they do is the team, they charge, I guess, like 4.5% yearly. And they rebalance your position all the time. So when your, like the Avalanche price is going up, what you have to do is that you have to move your funds closer to that amount that is currently trading. So basically when you're entering the pool, you're providing your funds to a certain basically price range. You're betting that Avalanche currently is $20, so I will provide my funds from the range of $15 to $25. So that's how you basically earn money. If you narrow down that range, you get more profit, but then if the price is going outside of that range, you end up like earning zero fees from that period. So to avoid that, again, like their team, the Traderjaw team, they do the rebalancing for you. So they move these funds for you. and you don't have to pay the transaction fees, because if you do this like manually by yourself, you have to like, one, monitor that, and two, you have to pay the transaction fees all the time that you do this. And they do this, I guess, like every 8 hours or something, so pretty often. And for volatile pools, I think it's a good option. If the crypto that you're holding, like FX, is not going like super high, then you will be like earning, I would say, much better interest rates than just like providing to the traditional pools. Though if you're using like the, not the EURC USDC, but like let's say USDC pool, then you'd better not use Autopools, and there's actually no liquidity there if you look to the right, because there is no sense to rebalance that if you know that the price is always like one. The correlation of US dollar in like USDT and US dollar in the USDC is always 1-to-1. So why should you like pay 4.5% for someone to rebalance that? It doesn't make much sense. For EURC, if someone is betting that like euro will basically fluctuate against US dollar or US dollars against euro, it may make sense for you, but still basically you have to do your own research here. And this option, I guess, it's only available right now on Traderjaw. At least I have never heard of other implementations, so it may be a good option for you just to do kind of a one-click deposit and earn pretty good revenue from the stablecoin pools. So that's it from me. Thank you so much, and would love to answer your questions.
All right, if anybody's got questions, we've got microphones. Put your hand. Let us know. Anybody? Questions, comments, concerns?
Hey, Misha. Mike. Hey, thanks for a great presentation, man. Let's talk about auto pools just for another minute, if you don't mind.
Yep.
APR is really low on them. What's the reason I would ever want to get in on an auto pool if I can't outperform AVAX staking?
So basically, currently, what do they have here? So they have the APR in the Autopool in the FX USDC at 360%. So I'm not sure if it's low for you. So that one, the 7.8 is like, I think it's like the farming fees. So, but the caveat here is that we all know that currently Avalanche went like super up. So it went from 20 to like 45, now it went a bit down. That's why just by holding FX, you would outperform this pool easily, because this is like, again, like this is 360 per year. It's not like per this period, and you could have earned like 200% in 1 month. That's the reason here. So that's why this pool like is super high APR. But if you go to the website and check another tab here in the polls, you will see that like the auto pool has higher APR normally than the general pool, because they rebalance it for you and take only 4.5%. Again, like on the 360% currently APR, 4.5% for the rebalance is nothing. And without that rebalancing, you would be probably out of the business when Avalanche went just like from 20 to 40 just like instantly. So that's the reason for use Autopool. And I've been using this like them a bit, and I think they're a great option for you just like to do and go on the autopilot without like caring about anything. Kind of easy option.
Anybody else? Oh, here, take the mic.
Probably a noob question, but how do governments tax you on that percent? Is it only if you convert that to dollars?
Sorry, from what?
Like if you're gaining an interest, do you get taxed on that, or is it only if you like convert it to like real money, say?
So normally, I'm not sure like in Canada, I'm not from Canada originally, but normally you're taxed in many countries when you withdraw crypto. So when you do the withdrawal to a bank account, then it's basically like interest rates on your like basically trading or whatever it is. So you just, if you enter like deposit $100, buy some crypto, do whatever you want, withdraw to 100, your profit is 100, then you pay taxes like normal taxes on this profit. But like again, like I'm not a financial advisor here, and I'm not sure about the Canadian laws, but pretty sure something like that.
Always check with your, always check is with your tax professionals at all times. Yeah. Especially depending on the jurisdiction you're in as well. So, yeah. Okay, any other final questions? Oh, one more.
I'm not a developer, so I do want to know just a little bit about. So say we're talking Traderjaw, and all of these pools that are available on Traderjaw. How many, from your perspective, like, how many smart contracts are we actually talking? Is it the protocol itself, or does each pool have its own smart contract actually allocated to it?
So technically speaking, I think in Traderjaw there's about like 6 major smart contracts. There may be some more for like price and something, but like I would say it's about like 4 to 6. And then what they do, they initially started like all these like decentralized exchanges. They started by having every single pool is kind of a different smart contract. They have all their own liquidity, their own funds there. But then they realized that there's like a lot of in-gas fees because you have to move your fee, basically when you exit in one pool, going to another pool within the same platform, you pay gas fees to like move your funds from one contract to another. So now what they end up doing is that they have just one smart contract that is normally called Vault, where all the funds are like stored. It's pretty basic, and it can be only triggered by other smart contracts from this ecosystem, so by a few other smart contracts from that like 4 to 6 amount. And then you interact with like the main smart contract where you just say which pools you're joining and then what are the settings there. So if you go like here, basically the settings are the pair, so the pair of tokens, 2 BPS, it's like the width of the interval. It's a bit technical, but basically it's what is the step size when you're setting the range of your price, which you will be trading in. And then I guess this most of the options like 2.1 there is like pool version. There's the smart contract version that is currently available that you're currently using. So that's more or less how it works. Was it like more or less clear?
Yeah, it's more or less clear. What's the top liquid staking protocol on AVAX these days?
I would say like on the Avalanche, like Traderjaw, it's native, and they are definitely one of the biggest, if not the biggest there. But then if you go to other chains, they are also supported by like Arbitrum, Optimism, but then there may be other big players there. So yeah, I would say on Avalanche, it's Traderjaw, almost sure.
I'll just have one quick question as well, please, Masha. Yeah, just with regards to any of these kind of situations, like this one, for example, how long do you find that people would want to be like staying in one of these? I know it's like 16% APR for this. Like, do people often stay in for a year or more, or is this something that you kind of want to get in and get out of a little quicker?
So I would say it depends on the pool. If you find some pair of less well-known tokens with some weird parameters, there may be a case that this pool was set up by someone like Whale, so people who have a lot of funds. So everyone, depends again on the platform, but everyone normally can set up these pools. And then if you enter this pool with, let's say, $500,000 there, the APR that will be like ultimately calculated for this pool will be crazy, because it's just like you swapped one half of the tokens for another one. So it's just like you will have a crazy percentage here. So you will attract a lot of other users there, and then you will normally exit in like 1-2 months to like fix your profits. It doesn't mean that the pool will not exist any longer, but this means that you may have like Whale coming in, you have a lot of volatility there, you have a lot of like APR there, and then Whale coming out, and you end up with like really low fees, like 3-5%. You may want to stay there for a while, but then it may be that like some other people will come eventually, but maybe you will just better go out from there. But for like pools like USDT, USDC, or like Avalanche USDC that are pretty popular, I would say there is no such situation. So you would normally want to stay there for like, I would say 3 months, maybe half a year, maybe up to a year. So that's not exactly like savings account. You can just like forget about this completely, but just like checking this like monthly, I would guess, for like major pools would be, in my perspective, enough for you to understand like whether or not it's okay.
Awesome. Thank you.
A question, is there something like an Autopool on the Polygon network?
I'm not sure, so you have to check this out. I've heard only about like the Traderjaw. I'm pretty sure they were the first one to introduce this, but this was almost a year ago, so maybe now other platforms will replicate this. I think it's a really great feature for someone who's just starting, so maybe there's other implementations as well.
You can look at Arrakis Finance. They also do it on other networks. I don't think they're on Avalanche, but I think they might be on Polygon, Mainnet, Optimism, and maybe Arbitrum too. But yeah, Arrakis, ARRAKIS, kind of like the Dune reference. So yeah, check them out. They're doing Autopools as well.
Great, thanks.
You bet. Anyone else? Okay. Well, thank you very much, Misha. Appreciate it. One more round of applause. And, thanks everybody for coming out. Feel free to fold up your chairs and we'll stack them up behind the door. Hang out for a little bit, and if you haven't scanned the QR codes, please feel free to do that. Join the Discord, get in on the conversation, and we'll see you here next Thursday. Okay, thanks. Ciao.